Well, thanks to Scotiabank to host us for the first time at your mining conference. We really appreciate being invited to attend. We're relatively new in Canada, but we expect to be a frequent visitor going forward. Here's a quick snapshot of evolution, if you don't know us. We actually recently celebrated our 10-year anniversary as a company. And I guess what I hope to be able to articulate to you today is just how we've set the foundations that we will have an even better second decade as a company. Today we've got a market cap of around $5.85 billion US, 9.7 million ounces in reserves, 26 million ounces in resources. And I think what I'd call out over here is the way in which we estimate our reserves, $1,090 US an ounce. We are plagiarists. We've used Mark Bristow's Rand Gold metric. He used $1,000 US an ounce. We're using 1,090. And that's really around the desire to get into quality assets. We're very focused on margin over volume, quality over quantity, and a small, highly concentrated, high-margin portfolio, which delivers superior returns to our shareholders. In a world which is increasingly risky from a geopolitical perspective, we think this is going to be an increasingly important issue for shareholders to contemplate. We have put ourselves in the Tier 1 jurisdictions of Australia and Canada very purposefully. They have great mining legislation. You know that your tenure is secure. They're transparent. They have great mining skills and they have great geology. And that to us is very important as we go forward in building this company, that we stay in these Tier 1 jurisdictions. ESG and carbon emissions is also an increasingly important aspect of our business. A few months ago, we made the commitment to reduce our emissions by 30% by 2030 and to be net zero by 2050. We are real believers that it's important for every business to commit to this. We have a pathway to deliver on this, and we expect to be able to articulating that. 70% of our emissions are from Scope 2 emissions, and they power from the grid to really drive our grinding media and ball mills. And that's where we expect to be able to transition to renewable power, which will help us meet those emission objectives. So how do you create value in this industry? Well, obviously the first thing you need to do is mine the gold that you've got safely, efficiently, and get that money into the bank. And then the conundrum really is, what do you do with that money? One of the things which gold companies seem to be a bit reluctant to do is give it back to shareholders. We're not. We've paid 17 consecutive dividends to our shareholders. But if you are going to spend that money, you've got to recognize that you really are a custodian of your shareholders' capital, and you need to be able to earn a better risk-weighted return by spending it on their behalf than they can. And that's where we, I believe, have a very focused and unique view of looking at things. As I said, we want a concentrated portfolio of 6 to 8 assets. We don't want to be the biggest. We want to be the highest margin. We want to position ourselves in areas which have great geological upside. Because in our view, there really are only a couple of ways that you can add value to a gold business. The first is to discover more ounces, or the second is to buy more ounces. Both of those have a relative amount of risk, but if you put yourself in the right geological address, and as you'll see, our assets, we believe, are in great geological addresses, you have a much better chance of delivering on that. Second thing is turnaround opportunities. Is there, and can you see when you're looking at something that you're buying, that there is a real opportunity to create value by turning the asset around? I hope to be able to articulate that when we talk about Red Lake. Synergies. One of our approaches has been to put our foot onto a very good geological address and then to expand our footprint around that, because then you can really deliver synergies from that. And then finding a motivated seller is also a very attractive way of creating value. There are times when an asset doesn't fit in a portfolio of a larger company, or they are, for some reason, under stress and need to sell. But those are the things which we think about. Geological upside is a necessity. The other three are very important to have, and as many of those that you can have gives you the best chance of delivering value. So moving through our assets, Cal, we acquired this in 2015. It's in Western New South Wales. We bought it from Barrick for 750 million Australian dollars. I think that was about $570 million, 550 million US dollars. At that time, it had a mine life that was going to only extend 8 years and close in 2024. It had 1.6 million ounces in reserves. And that, to us, is a classic bilateral negotiation with a major whose strategic objectives had changed. And we saw the opportunity at Cal to take it from being a relatively unimportant asset within a very large portfolio to, at that time, our most important asset. So we set about trying to really deliver value over there, and I think we've achieved that in spades. We took the reserve base from 1.6 million ounces to 4.6 million ounces. We have mined 1.4 million ounces already very profitably. That's generated operating cash flow of 1.2 billion US dollars and net mine cash flow of 570 million US dollars. And there's increasing opportunity over there. Through the drill bit, we have expanded that resource and reserve base. We recently committed to the development of an underground mine there, 285 million US dollars. And that will expand production from its current around 230,000 ounces to 350,000 ounces with a 17-year mine life. And again, importantly, that reduction in all-in costs, which we expect to be around 28%. So a huge value shift from 2015 to 2021, where we now have a 17-year mine life, 350,000 ounces, and pretty much all of our capital, our original capital for the acquisition, repaid. Red Lake's, we acquired it in 2020 from Newmont, again an asset which post the merger with Goldcorp didn't really fit in their portfolio. There is no doubt that Red Lake has had a tough last 5 or 6 years. It has been undercapitalized. It has not met its expectations. And really what we saw in this is a very good geological address, a very large mineral inventory, but a very big need for change and substantial change. What we are going to try and do at Red Lake, and what we are on the path of doing, is converting this from a 600,000 tonne per annum, very high-grade mine, selectively mined, to a 2 million tonne per annum, medium-grade mine with a head grade of around 5 to 6 grams. The geology and the scale of the mineral endowment suggests it is not only possible but very achievable. It is done elsewhere, and we're well on path to that change occurring at Red Lake. It's going to take time, but once we have completed it, and we expect to do it in the next 5 years, we'll have a 350,000 ounce a year operation at all-in sustaining costs of around $1,000 an ounce and a 15-year plus mine life. Which, if you think that all of our investments to get there will have cost us around $1 billion, the analogues against an asset that produces that amount of gold and has that mine life clearly reflects that we have the potential to add enormous value for our shareholders at this asset. It's going to be around mining. At the moment, we're mining in 3 areas of the ore body: the Lower Red Lake area, the Lower Campbell area, and the Upper Koshner area. The future is going to be about increasing the number of mining fronts. So we're expanding, and we've committed to develop the Upper Campbell area, the Lower Koshner area. Upper Campbell is going to be accessed via a decline development, so it gives you a completely independent and additional access point. And then the future is HG Young and McFinley's as well. So ultimately being able to really consolidate this, but have multiple mining fronts, feeding the 3 mills which we have at a 2 million tonne per annum type rate, and that will produce that 350,000 ounces of gold. Very confident we can deliver it. It's going to take time, it's going to take effort, but that is how value is going to be created. Moving to Mungari, another example of where we put our foot on a world-class geological district. It's outside of Kalgoorlie, and recently we acquired the Kundana and EKJV operations from Northern Star, which consolidates the district. So Northern Star had these mines, these high-grade mines, really a few kilometres away from our very efficient Mungari mill. They used to truck the material 60 kilometres away, right past our mill. And it's all on the same, these mines are all on the same geological structure. They're just separated by legal tenement boundaries. So putting that together, being able to consolidate the mines and get the synergies out of that is a real value creator, and real synergies have been delivered and will be delivered as we increase our opportunity at Mungari. So it's now gone from a 9 to 13-year plus mine life. We've got access to this higher production ore coming out of the Northern Star mines, and there are synergies and opportunities for expanding the milling throughput, bringing in some of the satellite deposits, and that will all be looked at over the next 12 to 18 months. Our most recent acquisition is going to full ownership of Ernest Henry. This is a copper gold mine that's is in the Mount Isa region at Cloncurry, 85 kilometres away from Mount Isa. It's a mine that we secured an interest in from Glencore in 2015, where we acquired an economic interest. It's been a fabulous asset for us since then. We have not only got our $880 million initial investment back, it's delivered $1.2 billion of net mine cash flow for us. And we've always had this standing arrangement with Glencore that if ever they were thinking of selling any more of Ernest Henry, please call us. Very pleasingly, Glencore kept their word and their commitment to that, and in the last few months we've been negotiating with them and reached agreement to acquire full ownership of the assets a couple of weeks ago. It's really aligned with our strategy. It gives us access again to a world-class geological position or mine. It's been consistently operated to high standards. It's got a great team on site, all of whom are joining Evolution. It gives us a very complementary and important access to immediate high cash flow because of our capital commitments at Red Lake and Cow. This is really important and complementary in terms of our capital profile. It lowers our all-in sustaining cost materially, and it was financed with low-cost debt via a private placement bond issue at around 9 to 10-year money at around 3%. So the transaction overview, we'll acquire, and the transaction should close in early January. For $1 billion Australian dollars, we'll acquire full ownership. We have 100% offtake of the material will be treated at the Mount Isa mill, and it gives us a very significant uplift to our copper reserves and resources, and you'll see in a second the impact that has on our all-in sustaining costs and cash generation. So the mine will produce around, on an annualized basis, around 60,000 tonnes of copper and 85,000 ounces of gold. We run a financial year to 30 June, so what you see in FY22 is really 6 months at 38,000 tonnes of copper, and then on an annualized basis it will be 60,000 tonnes from there. But what's really striking about this deal is the impact it has on our all-in sustaining costs. We treat the copper as a byproduct credit, and you can see that for the 6-month period we're going to hold it, it takes it down to about negative $1,500 an ounce, and then if on a 12-month basis you see the real impact where it goes to around $3,000 an ounce negative all-in sustaining cost. That generates enormous cash flow for us, around the $400 million at spot prices on the 6-month basis, and then around $500 million if you take it on a 12-month basis. So an absolutely incredible asset which we are really so pleased to have been able to secure full ownership of. And it's not only the cash flow that drove us to make the decision, it's also the exploration upside. and geological upside. So what you're seeing over here is the area, the PFS area, is the mine extension area. So that would take the mine life out to around 2030, 2031, extending the mine life to 9 to 10 years. And then there are significantly lower intersections in that grey area where the ore body has been intersected well below that, I think some 400 metres below the 875 level. We're not sure yet how economic that is, but that will be the focus of our next phase of work as we both take the concept study into pre-feasibility study stage, get confidence that we'll extend the mine life to that 9 to 10 years, which we already are. The concept study demonstrated a very robust return, and then 15 kilometres of drilling planned to both see just how deep this ore body does go. According to Glenn Masterman, there is no geological cutoff yet that he can see in any of the drilling. So very exciting times for Evolution on that one. It has a big impact on our costs. We talked earlier about our deep desire to be in that absolute lowest cost quartile, our desire to demonstrate that yes, we want to be in a lowest cost producer. We want to be making very good returns when the gold price is lower. We want to be making fantastic returns when the gold price is higher. We recognize we're in a cyclical industry, but we always need to be making good returns on our shareholders' capital. This puts us right at the bottom of the cost curve and cements our position as one of the lowest cost gold producers in the world. So just wrapping up, I hope you've got a clarity as to our vision and focus and the implementation over the first 10 years and the foundation that we've built for the next 10 years. It's focused on Tier 1 jurisdictions of Australia and Canada. We think that's really important. It's focused all about margin over volume and quality over quantity, cementing ourselves into low-cost, very geologically prospective districts, and then optimizing those assets and continuing to focus on a return on capital, because that is, in our view, will lead to superior shareholder returns over the long term. Thank you.